Welcome to the deep dive. This is where we take the sources you send our way, articles, reports, all that stuff, and really unpack the key insights.
Yep, exactly.
And today we're diving into some uh, big questions floating around the oil and gas world right now. Market trends, policy shifts. It's all based directly on the material we received.
That's right. We're aiming to guide you through it, kind of connect the dots based on what these reports are saying. Think of it as a briefing on what's driving the energy conversation this week.
Okay, great. Let's jump right in then. First up, a question that's definitely on people's minds, and it's right there in the sources. Why are oil prices climbing right now?
Yeah, good place to start. Reports from May 28th showed prices gaining, over 1%. Brent and WTI both moved up.
So what's pushing them?
Well, the sources point to a few key things converging. First, OPEC Plus met, and they agreed to keep their current output policy. Basically, they're holding production steady.
Okay, so no extra supply coming from them right now. That makes sense as a support for prices. What else?
A pretty significant development, the U.S. barred Chevron from exporting Venezuelan crude.
Ah, okay, so that takes potential supply off the table, at least for export.
Exactly. And then you've got the usual suspect, geopolitical tensions.
Always lurking, aren't they?
They really are. The sources specifically mention these tensions are, stoking fears about tighter supplies down the road, potential disruptions, things like that.
And I saw something in the notes about another meeting coming up, some OPEC Plus members.
Yes, that's right. There's some anticipation building around a separate meeting. It's happening May 31st, involves 8 OPEC Plus countries. Now, they could decide to increase output, maybe for July.
But the uncertainty itself adds to the current bullishness.
Precisely. The market's kind of waiting to see what happens there. And one more piece, non-OPEC Plus supply.
What's the story there?
The analysis we looked at shows non-OPEC Plus output has been pretty flat, sort of level, in the first half of this year. And you add in risks like, say, the Canadian wildfires potentially hitting production.
Right.
It just makes the reliance on OPEC Plus crude seem stronger, puts more pressure on that side of the equation.
Got it. So it's OPEC Plus holding steady, the Venezuela export restriction, geopolitical jitters, and not much growth elsewhere. It paints a picture of tighter supply, or at least the perception of it.
That's what the sources are reflecting.
Mm.
And the specific numbers reported for the 28th were Brent up 1.42%, hitting $65 a barrel, and WTI climbing 1.77% to $61.97.
Okay, clear picture on oil. Let's shift gears now. What about natural gas? The sources ask what's happening with prices there, and specifically, how do storage numbers fit in? That market feels even more volatile sometimes.
Oh, absolutely. And May 28th was a good example. Reports said July natural gas futures started the day with a massive gap higher, a big jump.
Wow, what caused that initial surge?
Two main things highlighted in the sources. First, a surprise lack of supply in storage tanks here in the U.S., meaning the weekly injection wasn't as high as traders expected. And second, forecasts calling for hotter temperatures across the country. So, less supply than anticipated, plus expected higher demand for cooling. Prices shot up.
But that wasn't the end of the story for the day, was it? The sources say prices then fell pretty sharply.
They did, a big reversal. U.S. NatGas futures ended up falling about 6% later that day. The June contract settled at a one-week low. It was its expiration day. And the July contract, the new front month, was also down around 4.6% by the close.
So what flipped the switch? Why the drop after the initial jump?
The downward pressure came from a couple of things. Expectations that gas flows to LNG export plants would decline.
LNG, liquefied natural gas.
Right. And also forecasts for sort of less overall demand this week compared to previous expectations. The market started focusing on those factors.
Okay, tell me more about the LNG export flows declining. Why is that happening?
It seems to be mostly down to maintenance, according to the reports. Planned work at several facilities. Cameron LNG, Cheniere Energy's Corpus Christi, and Sabine Pass plants. There were also some brief, unplanned reductions mentioned at Freeport LNG.
So it's scheduled downtime, taking some export capacity offline temporarily.
Largely, yes. And the outlook, based on these sources, is that feed gas levels, the gas going to these plants, will likely stay below the record levels we saw in April. That's expected to continue into June, mainly because of a longer planned maintenance period starting soon at Sabine Pass.
Okay, so the market sees less gas being pulled for export in the near term, which would ease some of the upward price pressure. Makes sense. What about the actual storage number that caused the initial surprise?
Yeah, so the official report for the week ending May 23rd showed an injection of 99 billion cubic feet, or BCF.
Okay.
That brought the total amount of gas in storage to 2,474 BCF. Now, here's the interesting part the sources highlight. even though that 99 BCF injection was less than expected for that specific week. The total gas in storage is still almost 4% above the 5-year average for this time of year, 3.9% to be exact.
Huh. So the market reacted strongly to missing the weekly forecast, even though the overall storage level isn't actually low compared to history.
Exactly. It shows you how much those short-term expectations matter in trading. Oh, and the sources also noted the Henry Hub spot price for the day was $3.20, down a bit from the prior day. And for the chart watchers, they mentioned some technical levels consolidation near 3.742 cents, a triangle pattern, moving averages suggesting potential price battles around $3.06 and 3.747%.
Right, so lots of moving parts. Storage surprises, maintenance, weather, technicals, a very dynamic market. Okay, let's move on from the day-to-day price swings. The sources brought up a really significant theme: the impact of recent federal workforce reductions on energy infrastructure and clean energy initiatives. This feels like it has bigger, longer-term implications.
It definitely seems that way, based on the analysis presented. The sources talk about reductions under the Department of Government Efficiency, or DOGE. They were framed as cost-saving, fiscal reform.
Right.
But the reports raised some serious questions about the knock-on effects. Things like stable energy governance, security, even hitting clean energy targets.
So the idea was efficiency, but the sources are saying there are real consequences for the energy sector. What kind of impacts are they detailing?
Well, one major area is funding for clean energy projects. The sources report delays in getting money out the door from big programs like the Inflation Reduction Act, the IRA, and the Infrastructure Act, IIJA.
So the money's there, but it's slow getting to the projects.
That's the picture painted. They specifically mentioned the Hydrogen Hub program rollout being slowed. This is linked to staffing issues at the Loan Programs Office, the LPO at the Department of Energy, which handles the financing for these big projects.
And that affects specific states trying to get these hubs going.
Yeah, the sources mentioned delays impacting project selection and funding in places like Texas, Ohio, Louisiana. And it's not just hydrogen. There's mention of a pause in disbursements under IIJA tied to a presidential executive order that has apparently paralyzed some projects aiming to expand the grid, especially utility-scale solar arrays.
Wow, paralyzing grid expansion projects sounds pretty serious. What about oversight and security? That seems critical when you're talking energy infrastructure.
Absolutely critical.
Yeah.
And this is a major concern flagged in the reports. They point to weakened oversight and monitoring capabilities across several key agencies. DOE, the National Nuclear Security Administration, and NSA.
Which handles nuclear security.
Right. Also the Bonneville Power Administration, BPA, which manages power in the Northwest, and the Bureau of Land Management, BLM, overseeing resources on public lands.
And weaker oversight translates to more risk.
That's the implication drawn in the sources, yes. Higher risk of financial mismanagement, cost overruns on projects, maybe less enforcement of compliance rules. Plus, there's the loss of institutional knowledge when experienced people leave these agencies, particularly mid-career specialists.
Did they give any specific examples? Those always help make it concrete.
They did. Reports mentioned layoffs at the Hanford nuclear site, for instance, delaying waste handling and reducing regulatory supervision there.
Okay.
And on the cybersecurity front for the grid, the sources talk about losing federal cybersecurity staff and reduced funding for resilience initiatives. This apparently leads to things like delays in software patching, slower responses to potential breaches, and just generally increased vulnerability to cyber threats.
So it hits both the physical infrastructure side, like Hanford, and the digital security side.
That seems to be the case. And related to the physical grid, the analysis pointed to layoffs at Bonneville Power, the BPA, potentially undermining its role in keeping the grid stable and integrating different power sources, including nuclear.
Which could lead to disruptions.
The sources suggest it increases the likelihood of operational disruptions, yeah. They mention routine maintenance getting delayed, grid modernization stalling, project backlogs growing.
How does this filter down to regions and communities? Are there local impacts being reported?
Yes, the sources indicate that many states and local areas just don't have the capacity to suddenly pick up the slack when federal expertise or involvement disappears. They mention permitting delays at federal land offices in New Mexico, which is a big deal for states relying on revenue from activity on those lands.
Right.
One source cited over 22 tribes and nonprofits affected by frozen infrastructure projects, mentioning about $350 million in federal funding tied up. And another specific example was the BLM office in Utah, reportedly losing over 55 employees.
That's a substantial loss of personnel. So with all these challenges, funding delays, oversight issues, project stalls stemming from these workforce changes, what do the sources say this means for the bigger picture, like U.S. climate goals?
Well, the picture isn't great, according to these projections. Despite the goals set and the progress started by the IRA, the analysis presented suggests the U.S. is on track to fall significantly short of its 2030 emissions reduction target. The range mentioned is anywhere from 23% to 37% short.
Wow, that's a big potential shortfall.
It is. And the sources seem to connect this erosion of capacity within federal agencies directly to hindering innovation and potentially diminishing U.S. competitiveness in the clean energy race.
Now, the sources also mentioned something about nuclear energy policy in this context, recent executive orders.
They did. 4 new executive orders were noted, aimed at supporting advanced nuclear energy. However, the sources also included a critique from the Clean Air Task Force, CATF.
What was their take?
CATF's view, as reported, is that these orders are helpful but don't really address the core financial challenges. They argue the orders lack policies for sharing financial risk or providing revenue certainty, which CATF sees as crucial to actually get the first wave of large, standardized, advanced reactors built.
So support in principle, but maybe not the mechanisms needed for large-scale deployment yet. And all this is happening under specific hiring rules.
Yeah, the context includes federal hiring constraints. There's mention of a 1 in 4 rule, only hiring 1 person for every 4 who leave, and a federal hiring freeze extended through mid-July. There's also a brief mention of legal challenges, with some judges apparently ruling parts of the reduction process unlawful, but not necessarily leading to widespread reinstatements.
Okay, so what started, as you said, framed as an efficiency measure, seems to have triggered, according to these sources, a whole cascade of effects across the energy landscape: funding, security, projects, even climate goals. It's complex.
It really highlights how interconnected everything is. A policy change here can ripple out in ways that maybe weren't fully anticipated.
All right, let's pivot back to a more specific market event. The sources asked, what does the U.S. barring Chevron from exporting Venezuelan crude actually mean? We know it impacted oil prices, but what are the practical details?
Right. So the core action is the U.S. stopping Chevron from exporting oil out of Venezuela.
And Chevron's response as of May 28th.
The reports indicated Chevron basically terminated its active contracts, production, services, procurement needed to operate there. But, importantly, they plan to keep their direct employees in the country.
So, stopping the work but maintaining a presence on the ground, what are the consequences highlighted in the sources?
Well, as we discussed, it adds to supply concerns globally, pushes buyers to look for alternatives. And specifically for the U.S., it affects those Gulf Coast refineries that were set up to process that specific type of heavy crude from Venezuela. They need to find other sources.
And is this situation new for Chevron in Venezuela, or have they been here before?
The sources actually provide that context. This situation is described as being similar to how things were during the first Trump administration. Back then, Chevron maintained its assets but couldn't really export much until the Biden administration issued a license in 2022, allowing some exports to resume.
So it's kind of a return to that earlier status quo: assets maintained, staff on ground, but no active exports.
That seems to be the strategy described, yeah. Retaining the assets without the current export risk.
Interesting how policy can flip that switch so quickly. Okay, let's tackle a company-specific question from the sources. Northern Oil and Gas, Inc. Stock symbol NOG. Is it a buy right now? What do the sources say?
Okay, NOG. The sources laid out some key financials, focusing on their first quarter results. EPS, earnings per share, came in at $1.33, which apparently beat the estimates.
Good start. What about revenue?
Revenue was around $602 million. That's a big jump year over year. Noted as about 51.9%, maybe 52% increase. Market cap is listed at $2.66 billion.
Solid numbers. How about returns to shareholders? Dividends, buybacks?
They highlighted NOG's dividend yield, which is pretty substantial at 6.67%. That comes from a quarterly dividend of $45 per share, or $1.88 annualized. The payout ratio looks comfortable, too, at 28.04%.
Okay, decent dividend. Buybacks.
Yes, the board approved a $100 million stock buyback plan. That allows them to repurchase up to about 3.6% of their stock.
And buybacks, as the sources often note, can be a signal from management, right?
Usually interpreted that way, yeah. Suggests management thinks the stock might be undervalued. The sources also mentioned strong insider activity. The CEO and a director bought more shares recently, and institutional ownership is very high, around 98.8%.
Okay, so you've got good Q1 results, a strong dividend, a buyback plan, insider buying, high institutional ownership. Sounds pretty positive. What's the overall analyst consensus reported in the sources?
This is where it gets a little nuanced. The consensus rating from analysts covering NOG is reported as hold.
Hold, really, after all those positive points.
Yeah, it's interesting, isn't it? The sources explain that while some analysts do rate it a buy or even strong buy, there are others with hold or neutral ratings pulling that consensus down.
Why the caution from some analysts, according to the sources?
The thinking seems to be that, yes, NOG has solid financials and shareholder rewards, but maybe, just maybe, there are other stocks in the energy sector right now that offer a potentially better risk versus reward profile. So it's not necessarily negative on NOG, but perhaps relative caution compared to other opportunities. One source did summarize the overall analyst view as a moderate buy, though.
Okay, so it's a good reminder that even with strong metrics, the analyst community might not be unanimous, depending on the broader market context. Thanks for clarifying that detail from the sources. All right, last question area. Technology. What's the latest in valve technology for oil and gas? Seems niche, but these components are vital.
Absolutely vital. You can't run these operations without reliable valves. The sources highlighted a specific new product launch. SPM Oil and Gas has introduced what they call the KOP AM20 series gate valves.
KOP AM20. And where would these be used?
Pretty much across the board in well operations. The sources say they're available for the wellhead, the tree system, choke and kill manifolds, covering drilling, completion, pumping, and production phases.
Okay, versatile. What makes them special? What are the key features the sources pointed out?
Several things stood out. One is their sealing capability. They can apparently provide a gas-tight seal across an incredibly wide pressure range from as high as 10,000 psi all the way down to just 50 psi.
That's a huge operating range, important for different well conditions, I imagine.
Exactly. They also have an advanced coating. This is designed to resist high wear and corrosion, but also provides low friction, which means it takes less force, less torque to actually operate the valve.
Easier operation, better durability, anything else?
Simplified design is mentioned, smaller and lighter than previous models, apparently, and they focused on part interchangeability. That's a big deal for operators because it simplifies their inventory needs for spare parts. Less stuff to keep track of.
Makes sense. How about longevity? Oil field conditions are tough.
They claim these valves are very durable. The sources state they can withstand harsh conditions for over 600 endurance cycles without needing grease injection.
600 cycles without grease. That sounds like a big reduction in maintenance.
It does. And they even translate that, saying in some uses, it could represent a 60-year lifespan. Plus, importantly, they meet a whole host of stringent API standards, the American Petroleum Institute qualifications. Things like the 6A PR2F test, the 6FA fire test, the 6AV1 sand slurry test ensures they meet tough industry benchmarks.
So all these features, wide pressure range, durable coating, simpler design, long cycle life, meeting standards. What's the bottom line for the companies using them? What are the benefits?
The sources boil it down to some pretty compelling numbers for operators. They claim these valves can potentially increase the time between maintenance by 50% compared to other valves.
50% longer between maintenance checks.
And they suggest it could reduce the actual cost of valve maintenance by at least 50%.
Half the cost. That's significant savings.
It really is. And by being more reliable and needing less maintenance, they help cut down on non-productive time, NPT. That's when operations stop because of equipment problems, and it's a major cost driver.
So, bringing it all together, what's the overall value proposition here, according to the sources?
It seems these valves help operators meet the tough well integrity standards required today, while also lowering the total cost of owning and operating these assets over their lifetime. Better performance, lower life cycle costs, helps them compete more effectively.
It really shows how innovation, even in something like a valve, can make a real difference to the economics and safety of the whole operation.
Absolutely. Those seemingly small technological steps are often fundamental drivers of efficiency and progress in the industry.
Well, that brings us to the end of this deep dive. We've covered a lot of ground, all pulled directly from the source material provided. We looked at what's moving oil and gas prices right now, the really complex impacts of those federal workforce shifts on energy infrastructure and policy.
The specifics around Chevron and Venezuela, a look at NOG stock performance and analyst views.
And finished with the latest in valve technology. Quite a range.
Each piece giving a different angle on the current energy picture.
Exactly. So
Yeah.
here's a final thought for you, something to chew on. Think about how all these different pieces, global markets, U.S. policy changes, a specific company's strategy in South America, even the design of a single valve, how they're all interconnected. They aren't separate stories, they're threads weaving together the future of energy. What part of this complex, constantly shifting picture will you dive into next?